the Fed Chair's Jerome Powell's commentary about the rate trajectory, maybe about what the hike and the commentary this time around could be as well. Let's get your top global voice, Jim O'Neill, visiting fellow at the Chatham House and former commercial secretary to the UK Treasury, joining us on the show. And good having you. Thank you so much for taking the time out. I think the debate would probably range from this being the first policy of Jerome Powell and how hawkish does he sound, to whether people preempt or people assume whether that the quantum of rate hikes would be 3 or 4 in nature. The Bloomberg poll, Jim O'Neill, seems to suggest that it'll be 3 with an indication or some hints towards a 4th one. What are you anticipating?
Well, let me first of all say thank you for having me on. Secondly, to say, obviously, I'm not as close to these things as I once was. I didn't spend the night thinking about this issue. I've got a lot of other things I'm doing, but it seems to me a quite reasonable estimate from your consensus of the poll. I would also add, I suspect the markets will be just as interested in the so-called dot plots for 2019 as well as 2018. And so not only will it be interesting as to whether the Fed shifts from 3 hikes to 4 hikes this year, but how many next year. And I suspect the markets will be very sensitive to both.
Jim, what you're suggesting is even if the guidance increases from 3 to 4 rate hikes for this year, that's already priced in by the global markets?
I think there is some. Clearly it's not completely priced, but there's definitely some suspicion that, given his hearing comments recently, that could be a consequence of today. Against that, of course, the very latest news on wages was slightly better than the surprisingly and slightly worrying news we got the month before. So I think it's reasonably balanced, but I think there is some suspicion that the Fed may up it from 3 to 4. And so in terms of, sorry.
Go ahead, Jim.
I was going to say, so this time tomorrow, if he just confirms 3 hikes and there's no additional hawkishness for next year, we would probably see equity markets having a relief rally. Whereas if he does go to 4, and if he were to indicate a possible faster pace of tightening in 2019, I think we would see a sell-off, particularly because partly to do, of course, with the Facebook issue, the whole tech sector, which is quite often vulnerable to a higher profile of interest rates anyhow, would be particularly sensitive, I think.
Jim, you mentioned about the wages data. What have you made of the recent economic data that's been coming out of the US market? The payroll data has been pretty good, and even if you look at the inflation, that's been firmer. Do you think they'll be able to meet the target of 2% by next year, and US economy is showing more of tailwinds than headwinds?
So it's kind of strange. The employment data, of course, remains very strong. And the sort of consensus view, not for the first time in life, is quite optimistic about the US cycle. But I think if you look at it over the past 3 months, at the margin, the data has been slightly disappointing in the US compared to strong expectations. And I think the Atlanta Fed's latest guesstimate for Q1, for example, is below 2%. So yes, the US economy has done well and the employment indicators are very strong, but not all the indicators are as strong as one might have thought, which maybe it's something to do with the seasonals. It often seems the US starts a year off with slightly disappointing evidence compared to expectations, but the mood, obviously, particularly amongst a lot of US sell-side analysts, it seems to be very positive still.
Jim, a lot of people are making a case that while the Fed may do what it does, the real indicators and the real market movers could well be the short end of the curve, the dollar IBOR rates, and all of which are already showing signs of moving up. So the Fed is but a sideshow to the real action that the markets are anyways seeing. What happens in such a scenario? I mean, does a hawkish commentary from the Fed really rattle the markets too much, or do the markets by and large start focusing on these elements, and therefore Fed does become not the main story but an ally story?
That's a very good question, and it's not easy to answer. It seems to me there is a bit of circularity here, but I guess at the core of trying to answer that question is that the markets basically realize the Fed is going to follow the data and try to make sure inflation doesn't pick up too much. So if the Fed reconfirms that, as I suspect they will, but if they say they are more concerned about the inflation outlook than before, then the markets will be very concerned. If, on the other hand, they take some relief from the very latest data that we discussed earlier, maybe we get a rally. But I think the underlying thing is almost whatever is said today and whatever the reaction, the markets, unless for some reason Powell gives a very, very different steer, the markets are going to remain really focused on the wage and CPI data, I think, in coming weeks and maybe months.
Jim, in light of all of this, what happens to global equities? Yes, the flows are okay. In fact, last week we saw a bunch of flows coming out of the money markets going into global markets, predominantly US, yes, but still going into equity markets. That said, if indeed the tone and tenor is of tightening, not just in the US but across the world, and that certainly seems to be a consensus out there, does it mean that equity investors have to brace themselves for a rougher ride than what they were earlier anticipating?
So I certainly think almost by definition, although I quickly add with a caveat, one of the few things I've learned in 35 years is never be overly confident about anything in financial markets. But almost by definition, I think this year is going to be trickier than recent years. I suspect we saw the low points in volatility back at the start of February when we had that surprising inflation data with wages. The Fed is clearly on a tightening path. It's just a matter of the degree. And in some ways, the real wild card out there, looking beyond the next few weeks, is whether at some point the ECB turns to a more hawkish stance as well. They've been, from what I can see, going out of the way to tell us that even though the European recovery is strong, they're in no mood to shift to an earlier tightening. But if the European data stayed as strong as it's been in the past 6 months, that could change too. So I think the equity markets are going to have a choppier ride. Excuse me. I wouldn't be surprised if we continue to make new highs in a number of places, but I don't think it's going to be with such low volatility as we've seen in certainly last year and in the previous years as well.
Jim, before we let you go, it's a given at least there'll be 3 rate hikes because that's the guidance. What's the view on the emerging markets? If these rate hikes are implemented this year, 3 or 4, what sort of fund outflows do you see from emerging markets to developed markets?
I've learned in the past to not get too excited about the flows. The flows tend to lag market and economic events. I don't see a lot of evidence that fund flows are leading indicators. So the flows will be a consequence of things that happen by and large. I think it's also a little bit trickier. I mean, obviously, again, historically, Fed tightening and some signs of concerns about inflation would typically suggest emerging markets won't do quite as well. That said, from a structural perspective and obviously a a very close thing to my past and my ongoing thinking about life, and I sort of have Mr. BRIC stamped on my forehead. I think with the relative rise of China and India, I'm not sure that just what happens with the Fed dominates so-called emerging markets anymore. Just the half an hour before I came on air, there's a lot of important policy announcements seemingly coming out of China about a new form of economic commission and all sorts of other policy developments. And if China continues to make the adjustment to a consumer-led economy that it's been making, despite some concerns about their chosen style of leadership, and if you guys in India continue the recovery you saw from Q4 with growth above 7%, I think for a lot of commodity markets and emerging markets, what happens just in the US is not as important as it was, say, 10 years ago. So you've got a number of mixed forces going on at the same time. So I think it makes for a very interesting time analytically and slightly less straightforward equity markets than we have been used to the past few years.
Okay, Jim O'Neill, many thanks for joining us today and giving us that perspective. Much appreciate your time.